Rob, this morning came news that Manny Roman, the chief executive of Man Group, is packing his bags, going back over to the United States to take the reins at Pimco, a fund management company that's been having a spot of bother lately, to put it mildly. Now that sounds like a very good deal for Pimco. Where does it leave Man Group, though?
Well, when Manny Roman came into Man Group in 2013, the group was in a bit of a shambles. The main fund, called AHL, which is an algorithmic trading fund, had been performing poorly. Investor money had been going out, and there was a relationship with the city was poor. He came in and he fixed those things primarily through diversification. So he bought two other funds, Numeric and Newsmith. So it's now, the Man Group becomes a more diversified fund group, which is a much less scary proposition for investors. So he is very well regarded in that he succeeded in that mission. But the question I think you have to ask is, at this point, how important is a CEO to a diversified fund group like Man?
Right, because basically he's ticked lots of the boxes already. He's done the heavy lifting, if you like. The guy who's taking over from him is
an insider,
a company insider who's worked at his side all that time, so presumably knows how everything works. Isn't it just business as usual?
I think there probably is some anxiety. I think investors had been hoping for still more diversification by acquisition. I think there's some anxiety that as the new guy comes in, maybe some of those deals will be put off. I wouldn't be particularly worried about that given how long he's been around. And of course, the Lexi point here is CEOs don't matter that much. At the end of the day, the question for investors here is, do you want to be invested in an active money manager at this point?
And do you? Or what about valuation?
Yeah, valuation.
What's the valuation?
Yeah, so the stock is appealing. It pays a dividend. The yield is up around 5%. That's a very attractive yield in the current environment. It trades at about 16 times earnings. So you are getting what looks like a value stock here in financials, and there doesn't seem to be big outflows of client assets and so forth. That's all good. The question is, how much of a discount do you want to give this thing for the long-term prospects of the industry it's in?
Which is this is passives eating active lunch.
Yeah,
right?
passives eating active lunch, and in general, pressure on fees paid to money managers. So if you look at Man Group's net asset margin, or net fee margin, in other words, the amount of money it charges divided into all the money it manages, it's already a slim margin, but over the last 5 or so years, you've seen it tick down a couple of base points at a time. So they are basically getting paid less for every dollar they manage. That's a trend that's true across the industry, and it's what investors have to be thinking about with Man Group.
Thanks very much.